Hey everyone, welcome back to The Explainer. I'm Steve. Today, we've got to look right at the fallout of what was, honestly, an absolute bloodbath on the tape. While the mainstream media is out there busy trying to paint this complex, rosy narrative, our job on this desk is super simple. We focus strictly on the hard numbers and the moving averages. We need to see exactly where institutional money is actually placing its bets. So, we're doing a full autopsy of today's programmatic market flush, looking really closely at the technical damage and the macroeconomic drivers behind it all. Let's open the ledger.
Right off the bat, I just want to hit you with the hard reality here. 7,267.08. That right there is the true settlement price for S&P 500 futures today. The index dropped a massive 1.62%. And what that means is the market didn't just drift lower. It didn't just casually backtest short-term support. No, it aggressively flushed into a full-scale programmatic liquidation. The macro algorithm stepped in and wasted absolutely no time taking over the wheel.
So here's our itinerary for today's briefing. 1. The multi-asset capitulation. 2. The gold shelf collapse. 3. Red folder data shock and tech dilution. 4. The energy curve disconnect. And 5. Professional trading directives.
Let's dive right into Section 1, the multi-asset capitulation, a coordinated liquidation.
When you look at the true settlement prints on the dashboard, they are just staggering. S&P futures down 1.62%, Brent crude down 1.62%, spot gold down 1.30%. Guys, this is a multi-asset capitulation. Literally everything caught a bid to the downside. Now, the crazy anomaly here is actually Bitcoin. Crypto managed this highly volatile defensive stand. It somehow absorbed a super heavy morning flush to stabilize completely flat into the close, up just 3 basis points at 61,712.90 cents. But everywhere else, absolute structural destruction.
Looking at the equity damage, it is incredibly severe. You can see the price action violently cracked right through established support lines. It cascaded over 1.5% to lock in that settlement right at the very bottom of the range. The algorithms were just merciless here, mechanically pushing price down on heavy volume until the closing bell finally rang.
Moving on to Section 2, the gold shelf collapse, structural destruction.
Spot gold took an absolutely brutal hit today, sliding down over a full percent to settle exactly at $4,189.75. For all our chart technicians watching, seeing this asset slice down to this specific level, well, that is a flashing red siren.
And here's exactly why that number is so critical. Gold has completely severed its long-term 200-day simple moving average. We call this a shelf collapse. It's like the floor just completely fell out from under it. When the primary safe haven asset of 2026 shatters its primary bull shelf on heavy volume, it tells you something you can't ignore. It tells you institutional capital is aggressively fleeing non-yielding safety blocks. Why? Because they're reading the tea leaves, and they realize the fixed income landscape is pricing in a highly restrictive Federal Reserve deep into the winter calendar. They simply can't afford to hold non-yielding assets in that kind of environment.
Okay, Section 3, red folder data shock and tech dilution.
So what actually caused this? Well, it was practically a perfect storm of twin macro and micro forces hitting the wire simultaneously. First, the highly anticipated red folder inflation data dropped. The Bureau of Labor Statistics reported the May CPI, and it basically confirmed our desk's absolute worst fears. Headline inflation printed at a red-hot 4.2% year-on-year. That is the highest annualized cost surge the market has had to handle in over 3 years. And to make matters worse for the bulls, the tech sector got totally slammed by a massive wave of capital dilution. Supermicro announced a staggering $7 billion equity financing package to fund its AI operations. That massive cash call sent its stock plunging 12%, dragging the entire chip sector right down the drain with it.
The crucial takeaway here is really this. Faced with a super hawkish 4.2% CPI print and these massive cash calls from megacap tech operators, institutional money made the only logical choice available to them. They aggressively reduced leverage, they hit the sell button, slamming the index down.
Let's pivot to Section 4, the energy curve disconnect, spot versus paper.
We are seeing this massive, honestly fascinating disconnect right now between spot and paper. Over in the physical spot market, cash Brent crude is averaging an incredible $105 a barrel. That is entirely driven by the choke point friction in the Strait of Hormuz, which has been going on for over 3 consecutive months now. But look at the active July paper contract on the other side. It is completely pinned at 91.89. It closed totally unchanged. The forward curve is actively refusing to validate the short-term geopolitical noise that's driving those spot spikes.
Just notice how the July 26 contract is pinned right to its technical anchor. It is refusing to break higher despite all the scary headlines. And why is that? Because the underlying macro data tells a completely different story. That data shows global fuel consumption is actively contracting, driven by multi-year low seaborne arrivals over in Asia. The paper market is trading the actual economic reality, not the headline panic.
The reality on the ground? Global corporate operators are effectively on a demand strike right now. They're choosing to just draw down their existing domestic inventories rather than chase those high-premium spot barrels. This disconnect acts as a critical release valve. It tells us that while the near-term headline noise is totally deafening, long-term supply expectations are actually still positioned for normalization.
Which brings us to our final part, Section 5, Professional Trading Directives, your morning blueprint.
First off, you really need to understand where the absolute line in the sand is right now. For S&P futures, with price action cleanly violating short-term moving averages, extreme pressure is now on our core intermediate anchor, the 50-day exponential moving average. Guys, this is it. If the market cannot find a firm weekly closing anchor and defend this specific level, the trapdoor basically opens for a much, much deeper technical correction.
So here is your action plan for the trading desk. Number 1, please stop trying to pick a bottom. Let the hard levels dictate your risk. Number 2, keep your eyes glued to the 50-day EMA for a firm weekly closing anchor. Number 3, cut down your position sizing and tighten your protective stops immediately. And number 4, let the programmatic selling clear out completely before you even think about putting capital back to work. Seriously, don't go trying to catch falling knives in a tape like this.
We've broken down that massive 4.2% CPI shock, the programmatic flush, and all the structural damage across equities and gold. So, knowing that the ledger is firmly locked into a deep technical reset, the only real question left is, are you ready for the morning bell? Stay disciplined out there, stick to the hard levels, and I'll see you at the open.